In this video, we briefly talk about learning objective 4, how to account for natural resources and intangible assets. And really for natural resources, the only two things that I would like you to know, that natural resources are those assets that we derive from nature. So it could be, for example, timber that will then later on manufacture into lumber. Could be coal, oil, ore, gold, platinum, nickel, etc. And instead of accumulated depreciation, we use such term as depletion because we deplete them. But the process is the same, and we cannot really use straight line method of depletion. So we use the units of activity, very similar to the units of activity that you used for property, plant, and equipment. So that's about all that I wanted you to know about intangible assets. So what are the intangible assets? The rights, privileges, and advantages that result from ownership of long-lived assets. And here's a big one, why they're different from property, plant, and equipment. They do not possess physical substance. They could have either limited life or indefinite life. Okay, so common types are patents. So that's the right to manufacture something. Copyrights, that's the rights for the work of arts. Goodwill, we'll talk about this one specifically. Then you've got trademarks and trade names, or franchises and licenses. Okay, so let's take a look at limited life versus intangible. If intangible has a limited life, then we will get to amortize it to expense. Amortization is very similar to depreciation or depletion. But instead of using accumulated depreciation, we will use a credit to a specific intangible asset account because it's literally shrinking, so to speak. If patent used to have 20-year life, now it's maybe down to 5. So that's why you don't have to create accumulated amortization account. And then if you have indefinite life intangible, then you cannot amortize it because you cannot divide it by a certain number of years. So that's something to remember. Okay, so here's your patent. You will amortize a patent because it is an exclusive right to manufacture, sell, or otherwise control an invention. And it has 20-year useful life from the date of the grant, right? Sometimes if patent is sold, for example, I had a patent for 5 years and I was the inventor, then when I sell it, then the patent will only have 15-year remaining useful life. So I had it for 5, next person for 15, overall is 20. That's why it says 20-year life or useful life, whatever is shorter. And also, when you see the word capitalized costs, when you're capitalizing costs means you will make them into an asset. If you're expensing cost, it becomes your expense. So in this case, you will be capitalizing cost of purchasing if I purchase the patent. And here is another little thing. So I don't know if you've heard of R&D. R&D stands for research and development. So if I'm trying to develop a new invention, so I'm obviously investing a lot of cash, a lot of inventory, labor, etc. So here's my cost. What do I do with this? Shall I go ahead and put it as a patent? Unfortunately, I can't. I have to expense it until I literally went and filed for the patent, and then cost of filing, etc., will become my cost of the patent itself. Legal fees incurred in successfully, that's the key word, successfully defending an asset, will be capitalized, meaning they will be added to the cost of that patent. So I will not be debiting legal expense because it's an expense in credit cash. I will debit patent in credit cash. But it has to be successful, right? Because if we lost, that means, well, we don't even have a patent. How else we would lose? If anything, you might have to take the patent off your books because you're not the inventor or the owner of the patent. Okay, well, here's the illustration. Assume National Lab purchase a patent. It costs 60. Estimate useful life is 8. So your annual amortization expense is 7,500. Cost divided by the years, and that will be the journal entry. Amortization expense, so very close to depreciation expense, and then look at that credit patent as opposed to accumulated amortization. Okay, copyrights. So how is those different for patents? Exclusive rights to reproduce or sell artistic or published works. So that's the big issue. And we have a useful life for that is extended for life of the creator plus 70 years. Okay, so if, for example, the author passed away in 1980, then you're going to add 70 years. Then in year 2050, then the copyright is no longer valid. That's why Mona Lisa could show up with a beard or whatnot. Cost of copyright is cost of acquiring and defending it, so very similar to patents. And copyrights are amortized over the useful life. Okay, so again, you have a limited life here. How about trademarks or trade names? These are the words, phrases, jingles, symbols, so you will probably remember Wheaties, Monopoly, Kleenex, etc. Legal protection for indefinite number of years of 20-year renewal period. And capitalized acquisition cost again, and then there's no amortization because we're dealing with indefinite life. Franchises. What's a franchise? Contractual agreement between a franchisor and a franchisee. So you know several of them, Shell, Subway, McDonald's, etc. And if a franchise is an agreement with a limited life, so for example, I bought it for 30 years, then I could amortize it over 30 years. If the life is indefinite, then you cannot amortize it. How about goodwill? What's goodwill? Goodwill includes exceptional management skills, desirable location, good customer relationships, skilled employees, high quality product, etc. Those items are not really on the balance sheet, but they definitely help. So for example, if I were to ask you, is it easier to start a business from scratch or to buy an existing business if everything else is the same? You're for sure going to say, I'm just going to buy an existing because all these items are already there and I don't have to put them in place. But they're not on the balance sheet of a company that you are buying, right? So there will be a difference in this case between the book value or the balance sheet value of that company versus the purchase price. So that difference is attributed to goodwill. Thus, you can only record goodwill when the entire business is purchased. So I cannot wake up this morning and say, I have exceptional management. Therefore, I'm going to record goodwill at $10,000 because I'm so good. It's just not going to happen. Again, goodwill is recorded as excess of purchase price over fair value of net assets. So what's net assets? Assets minus liabilities. So I look at fair value, so I've got an appraiser, I know how much it is worth, right? And then maybe there are 5 people who are trying to buy the same business and they bid the price up. I wonder why. Probably because I have all these other things that are not valued on the balance sheet. And goodwill is not amortized because we imply definitely. Okay, so R&D, research and development. Those are expenditures, right? Not expenses or cost. Expenditures are very similar to cost. That may lead to patent or copyrights or new process or new product, but we don't know for sure if they are or not. That's why Financial Accounting Standards Board said, unless you achieve a feasibility state of your product, you cannot capitalize R&D. Right? So R&D is expensed when it is incurred, whether it's successful or not, which is different from IFRS, International Standards, where R&D could be capitalized, meaning become an asset, sooner than it is in US. So sometimes it makes it difficult to compare to companies with heavy portion of R&D, such as pharmaceutical. So for example, if you're looking at Eli Lilly, which is based in Indiana, USA, versus you might be looking at Takeda, which is a Japanese company. So they will be following IFRS, and it's hard to compare in this case.